And we're super excited to have Devin on tonight. We've had Devin on before, and we wanted to bring Devin back because, again, it's 2025 and there's a lot of new tax strategies that you really do need to know, especially with everything coming up in this new year. And it is tax season. So you should already be thinking about it. And Devin, I'll turn it over to you. Go ahead and take control of the PowerPoint. But I think the biggest question we get right now is a lot of people are wondering what they can do because 2024 is gone and you're filing your 2024 taxes. Is it too late to make changes? And then you'll cover some of that tonight. So that's a big one. What can we do to help reduce our taxes?
Yeah, absolutely. And I appreciate just the partnership with Protect Wealth. Tax Hive has done so much with Don and Kendall and their team, and we're just grateful to be part of the family and be contributors here. We love this network and all the value that you guys provide. And so, thanks to everybody that's on the webinar here with us. I know how valuable your time is, and you don't have a more precious commodity. Like honestly, money and all these other things, time is your most precious commodity, and you're giving some of it to me here this evening. And so I want to squeeze as much out of that rag as I can, right? And give you as much value and training and content as it relates to taxes. And as Kendall kind of mentioned, hey, if you need individual tax strategy, advice, consulting, right? That doesn't happen in a one-to-many environment like this is. And so I'm not going to give anyone specific tax advice, but I'm going to introduce you to some concepts and ideas that'll probably shift your mindset a little bit and how you approach the tax topic. Here at Tax Hive, I mean, we're kind of game changers in the tax space. And we also have partnered with the, people like Kevin O'Leary as an equity partner in Tax Hive. We're not a small player in this game. We're doing things at a high level. And Kevin O'Leary is actually an equity partner in Tax Hive. So just quick, Kendall, I don't know if you can still see my screen, but you just got me and Kevin at his place in Miami, or I need to swap my displays? Everything's showing up,
That looks
right?
so good. I would
All
love
right.
I looks so tempting. We're stuck in the middle of snow finally. We got snow in Utah here. So that looks so beautiful. I
Yeah,
love
yeah, yeah.
it.
So that was last year. Kevin and I are bald brothers. We got the same, we have the same hairstylist, and he's got a good look. But I just want to start out by saying
Thank you.
we're a Kevin O'Leary company. And so for those of you that watch Shark Tank or pay attention to the things that Kevin is doing day in and day out, he's not just a spokesperson. He's not a, paid brand that's associated with Tax Hive. He's an equity partner in the business. He has an ownership stake in what we do here at Tax Hive. He cares deeply about the business owner here in America. And we know that all of us, in fact, I'll just ask this right out of the gates, and you're going to do this, with telepathy. I'll pay attention to your raise of hands, but how many of you don't pay taxes? And I always ask that a little bit facetiously. It's like everyone pays taxes unless you make no money, right? And we're going to talk about how you can reduce your tax liability. But if you're a taxpayer or you have any tax liability, you are my audience. You're the target person for Tax Hive to interact with and engage with. And as we have this conversation, and as I shift your mindset about how you think about taxes, all along the way, there's going to be an invitation for you to have a conversation with Tax Hive. It's very subtle. It's very, calm, and there's no pressure here. But if you want to have a deeper conversation about saving money, there will always be that opportunity. It's going to be in the lower right-hand corner of the screen, and it's going to look just like this, a little strategy call that says, hey, you can scan this QR code, or you can go to taxhive.com/PW, and I'll just leave that in the bottom right-hand corner as we go through things. But as you know, you're a taxpayer. We're a tax firm. And so what makes Tax Hive unique, or what makes us different than everyone else? Kendall kind of just brought this up, right? 2024 is in the rearview mirror. And many of you might be thinking, okay, well, now I've got to start meeting with my accountant and figuring out my taxes from last year. Well, maybe some sad bit of news. I mean, there's a few things that we could do, but the sad bit of news for you is that the clock already turned, right? Like 2024 is gone. It's over. And the accountant that you're working with, I don't want to, tarnish a relationship or try to disparage anybody. They're doing the job that you hired them to do, which is tax preparation. But think about it for a second. Hold on. We just had the entire year of 2024. And for some of you, you haven't had a conversation with your accountant since you met with them last April. And that's a massive problem in the tax space. Like, you and I are taxpayers, and I'm curious to know, like, in the Q&A, if you want to participate with me, some of you punch into the Q&A for me. What do you pay? Like, how much do you pay in taxes? And, is there a percentage that you're paying? When you think, how much do I pay in tax? What does that number look like for you? And I don't know of some of you that, okay, here we go. I've got Florence saying approximately 40 grand. I've got Christine saying 13%. Anyone want to outbid Christine? Anybody paying more than 13%? Okay, I've got an 18,000 from Amanda. You guys know the number as a percentage of income, though, right? How much do you pay? And I'll just start to fill in the blanks for you, because when I ask a question like this, people automatically, as you saw here in the chat, right, in the Q&A, you already assumed that the only thing I was asking was about income tax, because that's the one that you all, kind of automate to or immediately revert to. But in actuality, we don't only pay income tax. In fact, we pay a whole lot more than income tax, right? If you're a property owner, which I know many of you are real estate investors on this call, you know about property taxes. If you're in certain states, you pay state income tax. You also pay sales tax. Some states you don't, but in most states, sales tax. If you're not paying a sales tax, or if you don't have state income tax, well, then no problem. They'll get you on toll roads. There's death tax, inheritance tax, capital gains. In this country, which I love deeply and dearly, we are taxed when we make it. We're taxed when we buy it. We're taxed while we own it. We're taxed when we sell it. And in the case of healthcare, you are taxed if you don't buy it. Like, that is our tax scenario right now. And so back long ago, right, Benjamin Franklin or someone in our history said that a penny saved is a penny earned, right? And it may have been true when they said it back in the day, but that was before income tax. And now you and I probably feel like, man, I've got to make two just to keep one. And that's a problem. If you're only hanging on to 50% of your dollars, right? When you stack up all of the taxes that you and I pay, I mean, there's a dog tax in this country. You might, a dog tax, hold on a second. Well, in some states, you have to have a license, right, to have an animal, or to have your driver's license. Anything that you pay to have a license is also a tax. It's going to the government, and it squeezes you. Your gas bill, your phone bill, tax, tax, tax. Well, when you stack it all up, you and I pay way more than just the 10, 15, 20, or 30% on our income tax, right? Which brings me to my next point. Okay, if I can I out earn my tax rate? Like, can I just earn and make enough money to offset my tax burden? Well, maybe, but watch this. I have a little illustration for you that's going to compound money over time, and it's going to do it every single year. You guys have probably seen an illustration showing the compounding effect of money. This is a dollar doubled every single year for 10 years, and congratulations, at the end of 10 years, you've got $1,000. If we fast forward to the next set of 10 years, we're now out to 20 years on the calendar, and hey, congratulations, you've got $1 million in your nest egg. But you guys can already notice this investment was with no what? With no tax. Okay, well, is there a world that you and I live in where there is no tax? No, we're all paying some version, some form of tax. And so let me introduce to you a little calculation. If we rerun this example and we continue to double our money every single year, but now we're going to introduce a tax. And I'm not going to introduce the 40 or 50% that you and I are currently experiencing. I'm going to introduce just a simple 15% tax. 15, which if you and I were paying all in 15, we'd be, doing cartwheels and backflips every single day out of just gratitude that we're not squeezing all of the money out of our business or out of our operation, right, and our income. And I show you 15%, not because that's what you guys are paying, but because we feel like at Tax Hive, a 15% correction is super reasonable. For some people, we can eliminate all of their taxable income, but that's not everyone. So I want to use an example that's fair and reasonable. This is a 15% tax on the same money that we've been growing over time, compounding, doubling every single year, right? Well, at the end of 10 years, in the presence of a 15% tax, instead of having $1,000, you now have less than 500. Half of your money's gone. Where did it go? Think about that for a second while I show you the next 10 years, which is on when we get out to the 20-year mark, the same 15% tax, instead of having $1 million, well, guess what? You now have less than $250,000. And my question for you is, where did the money go? If we don't have $1 million and we now have 220,000, anybody in the Q&A dare to participate? Where did the money go? Right? And if the money is gone, did the government get it? Did your dog eat it? Right? There's all kinds of missing opportunity here. And the reason I'm showing you this, because I'm about to get into this tax strategy piece and I'm about to show you some real core strategies. But if I don't show you the cost of overpaying, you'll probably never care about the strategies, whether it's a home office deduction, Section 179, or other tax strategies. You're going to say, well, yeah, I just don't know if I'm going to implement that. Well, 15% over 20 years is the difference of about $750,000. And guess what? The money never existed. It didn't go to the government. The money never had the potential to grow. It never compounded because it wasn't in your business. It wasn't in your operation. It wasn't in your investment portfolio. It never had the potential to grow. And that's the difference between tax planning and saving your money versus overpaying to the government and doing it year over year. So how do we do this, right? TSJ in the chat is saying, hey, look, we all know we have to pay taxes. So where is the tax strategy and how can we cover this? Well, it all comes down to 4 pillars: maximizing deductions, strategic credits, tax gaps, and dynasty strategies. These are the 4 pillars to saving money. And on the maximizing deductions, I'm going to get into all 4 pillars, but I'm one of those people that kind of likes to see some of the more advanced strategies, some of the fun stuff, like spoil me on the movie. Let me know the ending and then let's watch it, right? This is a dynasty strategy that I want to show you right out of the gates. The dynasty strategies are the home runs. These are the triples, the big hits, right? And we're going to talk about some of the blocking and tackling, the basics, hitting a single and a bunt and a double here and there via deductions and gaps. But on the dynasty strategy stuff, this is where you see massive changes in your tax liability. Let me show you this. This is an accelerated donation. Okay, it's called an accelerated donation because what happens to your money on the donation is it gets a multiplier for a deduction. So watch this. Let's pretend for a second that you owe the IRS $100,000 in tax liability. And you're like, wow, is there another option? Could I have reallocated my money somewhere else and saved some tax dollars? Yes. On this dynasty strategy, the accelerated donation says, hey, instead of $100,000 to the IRS, let's take half of that money, not new money out of your bank account, the same $100,000 that you were going to send off to the IRS. Let's just take 50,000 of it and reposition it over here to this nonprofit, an eligible nonprofit. We're going to donate the money to a charity, and it has to be an eligible charity. I want to be clear on this. This isn't donating to the local food bank. It's not about, your local church or something like that. This is an eligible nonprofit. And maybe the best example under certain conditions might be something like the Red Cross, right? But when we make this donation, there's an accelerator, there's a multiplier that gives us a benefit on the 50K. Watch this. It's usually a 4 to 6 times multiplier. Just for sake of easy math, I grew up in the calculator days, so let's stick with a 5x multiplier. The 5x on the 50 grand is a $250,000 deduction. And I know you might be thinking, wow, Devin, 100 grand to the IRS and now I have a $250,000 deduction. Well, hold on, pump the brakes, don't get too excited. The deduction is not a net savings. Let me show you what I mean. We donated the 50,000. We have a deduction of 250 and we need to run that deduction through our tax bracket, right? What do we owe or what do we pay from a percentage basis? And if we're in a 32% tax bracket, well then congratulations, you have an $80,000 savings, except, hold on a second, pump the brakes again, we still donated 50,000. So the 80,000 minus the 50 gives us a $30,000 net benefit to our bank account that wasn't there a few minutes ago, right? We were going to send 100 grand to the IRS. And now instead of doing that, what you and I have done via tax strategy and planning is we use the accelerated donation to our advantage, and we now owe the IRS $20,000. We paid $50,000 to an eligible nonprofit with that multiplier, and we kept $30,000 in our bank account. And I don't know about you, but I like that a whole lot better than the $100,000 example, right? And when we make these decisions, this is all forward thinking. This is planning. This is strategy that happens during the game. I had a friend of mine that used the illustration of, hey, tax strategy is a little bit like the, Phil Jackson, Michael Jordan, Scottie Pippen relationship. Phil Jackson is the strategist, he's the planner, but at the end of the day, out on the court taking the shots are you, the individual, right? The business owner. You're the Michael Jordan or the Scottie Pippen that's implementing the plan and helping with the strategy, documenting things. But all along the way, TaxHive is helping you identify these opportunities, helping you do it in a compliant way that's in line with the code, legal, right? We're not doing anything that's out of bounds or, not by the book. And when we implement these strategies, we save money. So right out of the gates, instead of waiting till the very end, I'm going to make an invitation to you, which is, hey, let's have a one-on-one conversation. Everyone's circumstance is unique. Everyone's situation is a little bit different. And so we'd love at TaxHive just to have a personal conversation with you. This is usually a 10-minute phone call, maybe 15, to say, what do you own? Where do you own it? What industry are you in? How, where's your income coming from? And what does your current deduction stack look like? And can we at TaxHive enhance that at all? Can we improve it? My guess is, like most of our clients, I'll show you some real examples. We're going to find and identify for you a ton of savings that's missed by your current accountant or CPA. And it's not because they're doing anything wrong per se. It's just that you've hired them to do a different job. Kendall and I were actually talking about this before we started the webinar, which is tax preparation is its own discipline. It's a little bit like in the medical field, right? If I need brain surgery, I don't go to an optometrist. There are specialties. And the same thing exists in the accounting world. Our CPAs and our accountants also do tax preparation. We also do some bookkeeping. But our core differentiator, the thing that we specialize in, is figuring out and mastering the tax code and helping marry that code up to your business and your income to identify all of the opportunities for you to save money. And so here's the invitation right out of the gates. I'm not going to ask anybody for a credit card. There's no American Express, MasterCard, Visa on this call here. This is just simply informational content, maybe some motivation and some good vibes, right? But you should take advantage of the Protect Wealth relationship. Schedule that free strategy session and see what we can do. Now, everyone here in 2025 is asking us, well, what are the implications of the Trump administration and this new presidency, and how is that going to change the landscape of my tax situation? Well, let's rewind a little bit because, as you know, Trump once was already the president a number of years ago. And little history lesson, in December of 2017, he signed the TCJA. The TCJA was the Tax Cuts and Jobs Act that essentially brought down the tax rate and brought in a lot of incentives for business owners and other things. And here in 2025, those tax cuts in the Jobs Act are set to expire. That somewhere in 2025, unless they're extended, they will change. And when they expire, I just want to be transparent about what is currently on deck. And this obviously could change. I mean, if you open up X or Twitter or TikTok or Instagram, there's a lot of noise right now about, hey, can we have the external revenue service via, tariffs and other fees to other countries? Can they offset our income tax so that maybe Americans don't have to pay as much in tax? Hey, I'd be all for that. But the way that it's set up right now is that the Tax Cuts and Jobs Act is set to expire. And if it doesn't get extended, then the tax brackets increase. If you're in a 12% tax bracket, it goes to 15. If you're in a 22, it goes to 25, 24 to 28. You can see here on the slide. I don't need to repeat it to you. There's also the child tax credit that got doubled. It was formerly $1,000 tax credit, and then it doubled to $2,000 per child. There was the 20% qualified business income deduction that also is set to expire. Our hope is that these things get extended. In the absence of these things, there's still a bunch of code and deductions and credits and gaps that you as a taxpayer can take advantage of, whether they get extended or not. But this is some of the implications. And I'm guessing, if I were to place my bets, My guess is that Trump extends, his administration extends what they also already found to be viable and beneficial, right, to us as taxpayers and as citizens. My guess is that these things get extended, but we'll see how that all plays out. Now, when we meet with customers and clients, we ask questions. We're a business of inquiry that says, hey, how can we help? Where are we a fit? And when we onboard, we say, hey, what's your current situation like? We have asked this question that you see on your screen right now to almost 90,000 business owners, entrepreneurs, solopreneurs, asking, hey, how confident are you that your accountant is maximizing all of your possible deductions for your business and keeping you compliant with the tax code? And maybe not surprisingly, but unfortunately, almost 80% of them say, no, I'm not super confident that that's happening. And for me, that's a clue, right? That's a light bulb that goes off that says, okay, then I should probably do something about that. Like if my current CPA or accountant's not getting the job done, not cutting it, then what's the correction? How do I improve that? And we want to be that solution for you that says, hey, we're not just going to be your tax preparer. We want to be your tax strategist. Be a forward-thinking individual that right now in 2025, while you're thinking about 2024, it's actually the time and season for you to be thinking about 2025 and how are we going to mitigate, reduce, and limit your tax burden and tax liability next year. And the grand question for everybody on the other end of this call, right, is, hey, if I'm identifying some opportunities, and as Devin goes through this illustration, there's certainly going to be some things in the code that will save me money. Am I willing to do something about it? Maybe you are, maybe you aren't. I'm not here to, twist anyone's arm. But I think at the end of the day, it's up to us as individuals to say, yeah, hey, I'm going to take this seriously. And I think that I'm better served, my business is better served, my posterity is better served if I keep my money in my pocket. There might be a few of you that disagree with me on that, but the government is not a great steward of anybody's money. There's all kinds of waste. And I believe strongly that you should do something about it and you should keep your money in your pocket. If Kevin were here on the call, he's a straight shooter. He'd just say, hey, you got to plan for taxes. Shame on you if you don't. I'm not here to shame anybody, but I want to illustrate for you what the cost of doing nothing is. If you don't plan for taxes, how much money might be leaking out of your pocketbook? And we know the answer to this because we've kept track of the numbers. When we work with a client, we say, how much revenue is flowing into you on an annual basis? And then here are the average savings that we go identify for them with a tax plan. And if you scroll along the bottom of the screen there, you can see this business revenue. Many of you have investments, a real estate portfolio, you have taxable income. Maybe you're just doing your first 100 to 350 grand and it's like, okay, well, great. There's over $20,000 of annual savings on deck for you. That's the cost of doing nothing. If you just continue to do the old way of just meeting with a tax preparer, well, then eventually, you're going to overpay year over year and it's going to cost you in a big way. Let's be clear about the tax code. A lot of people misconstrue the code. They think it's their enemy. In some ways, you feel like Uncle Sam's pointing the finger and trying to scrape all of your money out of your pocketbook. Well, the code actually was written to incentivize behaviors that our government wants from us. So as a business owner, an entrepreneur, or a real estate investor, wherever your money is, they say, hey, risk your capital, put it to work, start a business, and we'll give you tax breaks. You can pay less. And so while our culture wants to villainize the people that take advantage of the code, it's actually the government that just, wrote these things into law. And you might say, well, lobbyists and, backdoor deals, I don't know. But it's in the code. It was written to incentivize our behavior, to risk our capital, our intellectual property, and start businesses. Why would they do that? Why would they take that bargain? Well, the government knows that small business is the engine of opportunity. We create jobs. We are the engine of economic activity in our country. And so for that, they say, okay, here are all the tax breaks for you, and here's the code. But guess what? The IRS is a massive debt collection agency, and they want to get as much money as they can, but they don't expect a penny more than you owe. And it's our obligation as a taxpayer to figure that out on our own, right? But if we implement the code and if we understand it, the deductions, credits, gaps, and dynasty strategies work in our favor. So here's a fun little survey for you. When would you like to pay taxes? Do you want to pay them now? Do you want to pay them later? Or do you want to pay them never. And I think if you're a W-2 employee, you already know, man, I pay taxes right now. I don't have a choice. They strip it out of my check. For those of you that have businesses, you might file quarterly, estimated returns. You can file later. You can even file extensions. But how in the world do you pay never? Like, is that even possible? A dollar flows into my business. Can I pay taxes never on that dollar? Is that even possible? It almost sounds like the Wesley Snipes, Al Capone type scenario, right? But it's actually not. This is not tax evasion. This is tax strategy, using the code in your favor to have money flow into your operation and actually, yes, truly never pay tax on that dollar because you understood the 4 pillars of tax savings, which is maximizing deductions, strategic credits, tax gaps, and then the dynasty strategy. So let's be clear about who Tax Hive is and what we do. Yes, we do tax compliance and tax preparation and bookkeeping, but our core offering, our unique selling proposition is for us to save you money with advisory services. And I'm not going to waste a bunch of your time with, find another tax firm out there that has thousands and thousands of positive Google reviews, Trustpilot, Better Business Bureau. You guys could spend time on this and go look at those. But let's just dive into some of the strategy. I know some of you are eager to hear and learn from some of this. Deductions is probably the most common thing. You're writing off interest from your mortgage. Some of you maybe a home office deduction. You're writing off your mileage, other depreciation, bonus depreciation. Well, here's Carrie, a notary business, actually right here out of Utah, and her tax plan identified over $28,000 worth of opportunity. 28 grand. I mean, for a notary business, that's a pretty sizable amount. But the most glaring thing on this entire slide that you see from Carrie and her business is what? It's not that she has another 5 years ahead of her to save 140 grand. For me, the most glaring thing is that she's been in business for 20 years. How much money was left on the table, right? How much opportunity was lost in the absence of tax strategy? And let me give you one of the key things that we did with Carrie and her notary business. We made a slight modification to her corporate structure. And as you all probably know, entity structure matters. LLCs, corporations, S Corp, C Corp. Which one is the right fit? Should I just be a solopreneur? Well, in Carrie's tax plan, we just simply identified the S election, which of the 28 grand, 15,000 of it was just in the S Corp election alone. A simple modification to her to her entity structure was almost over half of her savings in her tax plan. So these things are not oftentimes like groundbreaking, earth-shattering, nobody's ever told me about this. It was an S election, S Corp election for her corporate structure. Very simple. Now, I want to show you another deduction that's oftentimes misunderstood. You ever heard of the health savings account, an HSA? This is what we call a Roth IRA with rocket fuel. Like this is, a little bit on steroids. The HSA account is super powerful. It is a deduction, a version of a deduction in the code. And by the way, your accountant right now probably knows a dozen, maybe a couple of dozen strategies within the deduction stack. But guess what? There are over 1,400 itemized deductions. And this is why at Tax Hive, we try to emphasize this isn't a do-it-yourself project. Like you can't just go kind of, YouTube your way through this. There are deductions that do and don't apply to you based on your industry, your geography, your corporate structure, all kinds of implications. But let's talk about this HSA account real quick. This is one of the deductions that you should consider. It's extremely powerful and it gives you all kinds of benefits. You have tax deductible contributions. The growth that happens within your HSA account as you invest those dollars, right? Because it can be connected to a brokerage account. That growth is tax-free. Your withdrawals from the account, we all have medical expenses and things that, come up. Well, a tax-free withdrawal for anything that's a medical expense. You can cite IRS publication 502 on that one. The HSA account has annual limits on contributions, so you need to be aware of that, whether you're, single or married. There's also an implication that's regarding the deductible. you need a high deductible health plan. This would be like a $3,200 for a family or $1,600 for an individual. There are other limitations, like you can't be on Medicare, you're not allowed to be a dependent, but the HSA account deduction, extremely powerful. Like I would say most of you, this is going to be a fit for. And when we do some strategic tax planning for you, I wouldn't be surprised. Most of you are going to have an HSA account in your tax plan. Now, I'm seeing some of the questions in the Q&A. I've got Carthy saying, hey, guys, what options do we have for W-2 from tax strategy standpoint? So, Carthy, there are 12 standard itemized deductions. You have your dependents, right? Child tax credits. You can write off the interest that you're paying on your mortgage. There are a handful of other things, but you're limited as a W-2 employee. It's why we encourage at TaxHive to invest, to become a real estate investor, to start a business and risk your capital, become a solopreneur, start a side hustle. Those kinds of things unlock all kinds of opportunity for you within the tax code. I also see here, hey, do you work with equity traders? Yes, we have a lot of clients that are, equity, stock, and other investment accounts. That's their primary source of income. So yes, definitely, Hadley, I hope I pronounced your name correctly. If I didn't, forgive me. Keep me in your prayers. I always struggle with that stuff. Florence, I can see you saying, hey, do you offer services in Canada or for Canadians? Now, I'm deeply sorry, but we are a U.S.-based tax firm. You'd want to consult with a Canadian firm. The tax code is different there, but we do have a tax treaty. If you are doing some investing or some business in the U.S., you'd want to utilize us on the U.S. side, right, of your tax scenario. So wanted to address a couple of those. Let's talk specifically about strategic credits. Most of you have heard of credits, but it really didn't become a thing, like a popular thing or a common thing until COVID really put strategic credits back on the map. And let's rewind for a second. COVID hit, everyone starts to work from home, businesses are laying people off, our government pulls like the e-brake, right? The panic button, and they're like, oh my goodness, colossal collapse in the economy, all kinds of problems. And they went to business owners and they said, hey, we've got a wager for you, a trade-off. If you'll just keep your people employed, well, then guess what? We will offset that income. We'll give you what's called the employee retention credit, the ERC credit. Most of you probably heard about it. The ERC credit put strategic tax credits kind of back on the map for a lot of people to say, wow, these things really are viable. And what other credits are available out there? Well, let me show you a few of them, right? With the example of actual customers. So watch this. This is Sean and his tree service out of Florida. Been in business for 15 years. Well, guess what? He had the work opportunity tax credit available to him. What's the work opportunity tax credit? A work opportunity tax credit simply says, hey, in specific geographies, maybe even in certain industries, for certain communities or demographics or graduates, there are all kinds of incentives nationwide that say in the work opportunity tax credit, if you hire certain people, the government is willing to offset their wages and other compensation because you were willing to take a risk on them, or you were willing to, bring them into your operation and give them opportunities to earn income and, build a career for themselves. The work opportunity tax credit has a pretty broad reach. This other one, Virginia, Matt and his IT consulting business, the vehicle plug-in tax credit. Many of you have gone solar, okay? Like solar panels on your roof. Did you take the ITC credit? Did you capture the state credits? Did you know that as a business owner, if you have an intent to profit off of the panels on your roof, you actually qualify for a depreciation schedule on those same panels? These solar credits, when you go green, right? Vehicle plug-in tax credits, these are in the code. They're available to you. And it's just a difference of working with a tax strategist and a tax firm that's looking for these things, that's proactive about these things, rather than being reactive and waiting until you sit down in my office in 2025 and say, oh yeah, we could have done a few things, but it wouldn't have made that big of a difference. And so we can't do anything about it now. And here's what you owe. So that's what you're currently experiencing. That's the old way of doing tax business, right? And unfortunately, it's super prevalent. It's like the most common thing that tax accountants do. Now, I see your question, Ledger. Do you include international tax strategies? And I apologize for this, but unfortunately, we are a U.S. based tax firm. If you're wondering about tax benefits for you to do business outside of the U.S., I would maybe say this is one of the 2025 things that is ultra prominent with the Trump administration, is this focus on America first and American capital and American made products. And my guess is that anything that exists in the tax strategy currently for international stuff, obviously tax treaties and stuff like that, I don't anticipate changes, but we are repatriating all kinds of investment dollars. And there's a real big focus on bringing things back to the US, right? From both an investment standpoint and from a tax strategy standpoint. So not a whole lot there. An anonymous attendee, do you work with people with short-term equity gains as main source of income? Yes. So short-term equity gains, capital gains, all of that, we can offset your income with all kinds of other deductions, credits, and expenses and or dynasty strategies where you're making investments in other places that have tax benefits. So yes, absolutely. Now, let's talk about one more on this tax credits piece, the R&D tax credit, like research and development tax credit. You might say, well, yeah, convenient for Elias in California. He's in a semiconductor energy business, right? The R&D tax credit says research and development in certain sectors and industries, the government will give you credits on your taxes to offset the wages for people that are doing the research and development. They'll even offset the expense for product materials and equipment that's related to the research and development. R&D tax credits are actually a really prominent and common thing that we're identifying in tax plans for certain industries. Now, I want to be clear here, because anytime I bring up R&D, people are like, well, I'm a plumber, or I'm a real estate investor, or I'm trading stocks, or I'm a W-2 wage earner. And so maybe I can't get access to some of these things because my name isn't Warren Buffett, Jeff Bezos, or Elon Musk. And it's like, no, hold on a second. None of these guys are specifically named in the code. These guys just have a team of strategists that are always reviewing their scenario and helping them maximize the code in their favor. And you're not a whole lot different. You're just maybe operating at a different scale and scope, which is why Tax Hive exists. We bring the high-level Fortune 500 expertise in tax strategy to the, call it, ordinary person, the non-Elon, right? And that's the benefit of working with a Tax Hive compared to your Yellow Pages accountant that, has one front desk attendant and a filing cabinet, right? Like just big tax firm advice to the small business owner at scale. Now, I'm seeing here in the chat as well, how much do I need to be earning before I can realistically benefit from your service? This is a fantastic question. The question here is, hey, as a solopreneur or as a business owner, what if I'm not profitable yet? Like maybe I'm pre-revenue. Like maybe I haven't even made any money yet. Well, that's actually a really important time to be banking your losses against future gains, right? You may have had a loss in 2024, but if you didn't document it, well, then when you have a gain in 2025, you're not going to be able to say, hey, I actually have some offsetting expenses from these losses in 2024 that carry forward to 2025. So that's item number one. Item number two would be, I'm now profitable. I've maybe made my first 50, 100, or 250 grand, whatever it might be. I would say right about the threshold of 75 to 100 grand, you're starting to get into territory where you owe enough in taxes that it's worthwhile for you to do some tax strategy and tax planning. If I went back to my original diagram, you'll see it here in a second again. This diagram of what is the cost of doing nothing, or better yet, what's the reward of doing something with Tax Hive? If you were just earning your first 100 grand, there's typically about $15,000 in potential savings. That's like on our average when we work with a client that's in those early stages, there's usually about $15,000 of meat on the bone. And I would just ask you, how important as a new business, new entrepreneur, how important are those dollars to you? And I think you could argue that they're probably more important than, the person that's doing millions of dollars in revenue that can potentially recapture 200 to 300 grand in tax savings, right? And the follow up to this is, hey, is it 75 to 100 grand in profit? No, this is in gross revenues, top line revenue. Okay. And I see Pat here saying, have you heard any updates on having to file the beneficial ownership report? Is it still on hold via court order? I actually think the Supreme Court just overruled that, yes, you have to report. And maybe Kendall, if you want to chime in on that, but I just heard on Monday that the Supreme Court voted that you still have to report, make that beneficial ownership report on your entities. So yes, I believe it's back on, despite what happened on the Texas side of things. All right, so tax gaps. This gets really fun. Tax gaps are something that the average accountant, when we bring a tax gap strategy to them, they're like, oh yeah, like this is a red flag strategy, or this might trigger an audit. Which, just for everyone within the sound of my voice right now, just know that is like code for, I don't know what I'm doing. I don't fully understand the tax code, and I'm a big weenie. Like I'm a chicken. I'm afraid of the tax code. I don't understand what it says, or I'm not confident enough in my interpretation of it to stand behind it. And that for me is a massive clue that you probably need to work with someone else. Because let's be real for a second. If I just hold up my hands here and say, hey, on the left-hand side for you guys, my right hand, but your left, on the left-hand side is the tax code, okay? This is what's legal. This is what's compliant. This is what has 70,000+ pages of legislation written to interpret the code. And odds are your tax preparer that checks boxes and inputs numbers into other fields and does a little math calculation to tell you what you owe, they're probably not spending their free time mastering the code and the legislation that's been passed around the code. And over here is that tax code that if you were this close to it, you'd be paying as little as you legally compliantly owe. And what's happening right now is you're working with a tax preparer that out of fear, ignorance, or I don't know what, has you paying this much. It's maybe out of frame, right? And the gap, like between what you're currently paying and the actual tax code, guess what? It's your money. Like your accountant, your tax preparer probably doesn't care that much about it. They should from a fiduciary standpoint, but they're not doing it because you didn't pay them to pay attention to it. You paid them to prepare your tax return and simply tell you what you owe the government. It's a little bit like a cashier. And if I can use the cashier analogy really quickly, right? When I go to the grocery store, it's not fair of me to get mad at the cashier when I didn't use the rebate or the coupon, or I went down the wrong aisle and I grabbed the wrong item that didn't have credits, deductions, tax gaps, and dynasty strategies attached to it, right? Like there's a benefit to going to Costco instead of Harmon's or your local grocer because you get some buying power, right? And it's our responsibility to shop at the right places and to take advantage of the right code. That's the difference, again, between tax preparation and tax planning. And the difference, again, is all of your money that's in between. So tax gaps oftentimes get misconstrued as loopholes. They're not loopholes. They're just in the code available to you. So let's talk a little bit about this. I've got right here, Alva, real estate broker out of Kentucky, $26,000 of potential savings identified in Alva's tax plan. Now, Alva's tax plan had a couple of things. It had the bonus depreciation, which is actually a deduction. The tax gap that was identified in Alva's tax plan was what's called Rule 280-A. Rule 280-A. Everyone should put this in your notes, commonly known as the Augusta Rule. And I know it's a little after 7:15 here. I'm going to be wrapping up here in just a second. But this one is critical. Almost all of you should be taking advantage of the Augusta Rule. Why is it called the Augusta Rule? Well, think of Augusta, Georgia, where the Masters takes place, right? The rumor is, I can't verify or prove that this is accurate, but people have rumored that there are people in Augusta, Georgia that rent out their home for about 2 weeks out of the year when the Masters comes to town. They make hundreds of thousands of dollars, depending on the size of their home, when they rent it out for that time. And a few of them made some phone calls to lobbyists and people that are influential up on, Capitol Hill, and they got passed into the tax code, Rule 280-A, that says, hey, you can rent your home out to your business up to 14 times a year and do it tax free. You heard that correctly. You can rent your home out to your business, to your entity, to your LLC, whatever it is, 14 times a year for a business purpose. You can't just pretend. You have to actually hold a meeting, hold a conference, have a training event, have a employee appreciation breakfast and training or luncheon or whatever you want to do. You have to document that the meeting took place. You have to invoice your business. But guess what? When your business pays that invoice, it's tax deductible to your business as an expense. The invoice that gets paid, those dollars that flow to you as an individual, guess what? Tax free. So then the question is, how much do I rent my house out to my business for? Like, what's the going rate? Well, it's a lot like renting your, local Marriott or a Hilton for a boardroom or a conference room. What's the going rate? You'd go to peerspace.com. That's PERSPACE.com, peerspace.com, to gather a comparable. All tax strategy comes down to documentation and implementation, doing it the right way. So that if you go onto YouTube or TikTok right now and you find, Reddit is a plethora of, it's a cesspool of tax strategy and experts that anonymously think they know what they're doing. But then when it comes down to it, you need to know how to implement and document properly so that you're in a defensible position. So that if the IRS ever comes knocking, which by the way, they don't knock in person much anymore, it's always just a paper audit. It's like, hey, you did Rule 280A, you cited this, tax gap in your tax filing. We just need the documentation. Can you prove it up? It's like, oh yeah, TaxHive helped me do it. Here are the documents, and you're good, right? So the tax gap that Alva had in her tax plan, Rule 280A, applies to almost all of you, and it's usually to the tune of about $12,000 to $14,000 a year in savings. Now, Tam Lynn and her Body Works massage business out of Texas had over $16,000 of potential savings in her tax plan. It also included Rule 280A. It also included the S Corp election. It also included a bunch of other deductions and credits and gaps. But $16,000, I think, for the average person is like, oh, yeah, I'd like to have that 16 grand. That for a small business or for a startup or a solopreneur or a real estate investor or a stock, broker or whatever you're doing, a stock trader, that 16,000 is like, oh, I could reinvest that. I could pump that into my marketing. That would help me cover payroll. That might help me buy that technology platform that I need to work more efficiently. I know that those dollars are far better used by you and your business than sending them off to the government. So dynasty strategies. I already showed you the accelerated donation illustration. For those of you that jumped on late, instead of paying the IRS 100 grand, we donated $50,000 to an eligible nonprofit. We got a multiplier on that donation of 5x, which gave us a deduction of 250 grand. And we didn't save 250 grand, we got a deduction of 250 grand. And the deduction has to be run through your tax bracket. If you're in a 30% tax bracket, right, $80,000, but we didn't save the 80, we still donated 50, which gave us a net savings of 30,000. So let me show you mention a couple of other dynasty strategies that you should put in your notes. Because similar to the accelerated donation strategy, instead of owing the IRS 100 grand, you might then owe them 20 grand. You might donate or invest or do some other strategy that has a $50,000, tag on it, but you still kept $30,000 in your business. So where does this happen? The accelerated donation strategy, oil and gas, mineral deposits, conservation easements, cost segregation, solo 401ks or other retirement accounts. There are all kinds of dynasty strategies that build long-term wealth that have tax benefits to them. And I know you might be thinking like, oh, well, Devin, I don't want to invest or pay anything else in order to save money on taxes. No. Hold on a second. Virtually all of the dynasty strategies that we teach utilize dollars that would have already have been sent off to the IRS unnecessarily. And instead of doing that, we're just going to take those same dollars and reallocate them. It's called a reallocated investment strategy, where we just position them in a different place. We get the tax benefit, and then we owe the IRS less money, right? Okay, so I've got another question in the chat. When I had my business, I leveraged by my timeshares for team events and attending conventions. Awesome. Great. As you should, right? Real estate has incredible tax benefits. Like writing off the interest that you're paying on any debt or mortgage, right? You then have depreciation on the asset that you can depreciate the value of the home or the rental property that you bought. Like the tax benefits of real estate are almost unmatched. I've got another example here. I'm not going to spend too much time on this. Junius is actually a buddy of mine. I've met him multiple times. He's out of Georgia, been in business for 6 years. He helps VA veterans capitalize or take full advantage of their disability benefits. His tax plan had some bonus depreciation in it, had the Augusta rule in it, had, I believe, the S Corp election. He also had this reallocated investment strategy, commonly known as a conservation easement, which, by the way, if you go and Google conservation easement, there's a bunch of mess and noise around it with people that did it the wrong way with the wrong people. It's why you don't use YouTube and Reddit as your tax planner. So just be conscious of that. But when you work with the pros, we stand behind our work and what we teach and what we introduce you to. This moving business, like I show this not as an outlier, like this is pretty common for us, $73,000 in identified savings. This moving company, I feel like too often business owners and entrepreneurs are like, well, I'm just kind of a little guy. Like I only have a couple rental properties, or I only, trade a little bit in the stock market, and I don't have a ton of, well, I mean, a moving business had almost 75 grand of identified savings spread across all of those pillars: dynasty strategies, tax gaps. I don't know that they had any strategic credits. Maybe they did, but certainly on the deduction side, a healthy, smattering of opportunity and deductions. Now, I showed you this up front, the cost of doing nothing. It's also the reward of doing something about your tax scenario. And again, you're all in different circumstances. Some of you are business owners, some of you aren't. And guess what? If you're not a business owner, we still have ways that we can work with you and help you navigate the tax return. If you're not happy with your tax preparer and you want someone like Kevin O'Leary in your court, then great, scan the QR code. We'd be more than happy to help you. But if you have any version of a business, a side hustle, or an operation that you're running, these are the real savings that are on deck for you to capitalize on the tax code that's already been written in your favor. And to the question that was cited earlier about, hey, if I'm just doing my first 75 to 100 grand in gross revenue, there's that 15,000. And where do we pull these numbers from? Like, how do I get an average? Like, Devin, is this a sample size of like 50 clients? No, this is over three. It's actually over two. It's close to three, but I can say it's over 2,000 specific tax plans that we've delivered to real clients through our platform and through our services. So it's not some, miniature sample size. This is business owners across the US, all 50 states that we work in. And, we stand behind these numbers. Odds are, this is a safe bet. Odds are when we deliver a plan for you, it's probably going to be more than what you see on the screen here. So Kevin would tell you, hey, you work so hard to grow your business and to grow your portfolio and to grow your investments. Don't overpay on taxes. Why would you do that, right? Instead, let's do something about it. Let's be proactive. Let's just have an experimental call. Let's have a discovery call. Is TaxHive the right fit for you and your business or your income? Maybe. I'm not arrogant to say that, yes, it automatically is. It might be. And it's probably worth a 10-minute discovery call to figure that out. Which brings me to kind of my final point. Hey, let's jump on a call. Let's go to taxhive.com/PW for Protect Wealth. We'd be more than happy to have that conversation with you in a one-on-one environment. And I see here in the Q&A, if I'm buying an investment property, should I buy it in an S Corp or under my personal return? Okay, investment properties, let's just eliminate the tax conversation for a second. 100% your investment property should not be in your personal name. I think you're maybe saying, hey, under my personal return. You want to have it in an entity to create separation from an asset protection standpoint so that if anything goes wrong with your property, like something that happens to your tenant and they want to sue you, you don't want them getting access to everything else that you own, right? So just from a liability standpoint, if you were to talk to an attorney, which I am not, they're going to most likely advise you keep that in a separate entity and take advantage of the tax benefits. The S corp election question on this: should I buy it in an S corp? Maybe ask yourself, what are the rents? Like, is this a nightly rental and you're doing over 50 grand or 70 grand a year? Or is this like hey, I've got, a rental property and I'm making 15 to 20 grand a year on my rents? In that case, probably not. The S corp is usually a $50,000 or more type scenario when you start to consider the S corp election. So hopefully that answered your question. Again, TaxHive would love to spend a little bit of time on the phone with you. This is a really no pressure. Just engage with us, see if we're the right fit. If we are, great. We'd love to earn your business. And when you do, here's the cool thing. We have some guarantees in place that say, hey, if we can't save you at least X, we'll just refund your money, right? Like, we stand behind our proposition, and we stand behind our work. And if it's not going to be a benefit to you, right, then we would move on and find another fit for you. But I promise you, for the bulk of you that are listening to this call, please, for yourself, for your bottom line, for your pocketbook, for your family, pay less in taxes, keep more of your money, and we would love to be your partner in that venture. Kevin O'Leary, our team, I would say the one thing that separates us from everyone else that's out there in the yellow pages that you can find on a street corner from a tax and accounting CPA standpoint is that we're an educational firm. We spend 2 webinars every single week that are an open forum Q&A. It's called Ask a Tax Pro. Good luck finding another tax firm that twice a week will open their, resources, their CPAs to you on a personal level and say, hey, any question you've got, let's field it, let's answer it, let's take care of it together twice a week. Ask a Tax Pro. So tons of ancillary benefits to being a part of our network. And again, Protect Wealth, thank you so much for having me on. I hope that this has been informative or motivating. You might ask, why did they bring Devin on, the president of TaxHive? He's not the CPA at TaxHive, he's the president. Well, you would have gotten the same information from the CPA, but he or she would have just put you to sleep. So I'm the energy guy. I'm the one that's going to keep you alert. And I appreciate you paying attention and bearing with me as we work through this. I know taxes is never the most exciting topic, but Kendall, I'll turn it back over to you. I see here the anonymous attendee, any advantages on getting a trust? Yes, massive advantages both on the protection and the tax front for you to have a trust. That's like a sure bet on just all of your estate planning and the implications of that. I think Don and his team are experts on that side of things. No doubt, a trust is highly recommended. So, Lawrence, God bless you, brother. Thanks for sharing your gratitude with me. I'll leave with this. I'm a grateful person. I express my gratitude for every single one of you just listening and giving me your time and paying attention. I know that life is busy and there's lots of distractions, but be grateful. I promise you, if you're grateful, you'll be more successful in your business. You'll be a more happy, entrepreneur. You'll see more abundance in your life. Your relationships will be more rewarding. And for that, thank you. God bless you and wish you the best. And you've always got a friend here at TaxHive that can help you along the way on the tax front if you need it. So,
bravo. I am grateful for you, Devin. Seriously, thank you so much. We are grateful to you and to TaxHive for offering a free consultation. I love that. A strategy session, guys. If you haven't done a strategy session with a tax professional, maybe your brother-in-law does taxes, maybe someone down the street you've used for years. If it doesn't hurt to get a second opinion and look at it, it really doesn't. We highly, highly recommend it because taxes are changing constantly. It's really important you take a look at it and get a different opinion, someone who does it day in, day out. And the thing about TaxHive that we love is, and Devin mentioned this, they're a large firm with a lot of firepower. A lot of your people we've worked with, Devin, it blows my mind. You cannot stump them. To know the tax code like your people do, I've never seen anything like it. It's unreal. They must stay up all night reading the tax code. It doesn't make sense to me.
Yeah, Gene, our head accountant, our head CPA, his name, and I'm not making this up, is Gene Bot. And we joke around the office that he's a robot, like bot, like he's an AI bot. The guy has his mind is a freaking trap. So, yeah, it's fun around here, man. We have a good time with it. And I appreciate John in the chat also sharing his gratitude. Back at you, John. I appreciate you, brother.
Thanks so much, Devin. We appreciate you. Again, appreciate the offer, guys. It's in the chat. Go ahead and click that link. Sign up. We strongly recommend it. That's the reason we bring Devin and TaxHive on, because they'll do a great job with you. Devin, thanks so much for being on. We are grateful for you. Reach out if you guys need anything. A pleasure having you on tonight. Look forward to seeing you guys all again soon.
Thanks so much.
Thanks,
care.
guys.
We'll see you.
Take care.